Well, hello, traders and investors. My name is Roger Scott, and today I am, by the way, my name is Roger Scott, and I'm the head trader for Wealthpress. It probably helps to say that. And I've been doing a lot of videos on different stocks to buy and sell, but I want to show you today something really, really cool. I want to expose you to my favorite indicator, all right? Now, you're probably thinking, it's probably a trend indicator or a directional indicator. It's something that'll tell me where to buy and sell. But what if I tell you that my all-time favorite indicator has absolutely nothing to do with figuring out or telling me the direction of the market? It has nothing to do with telling me if I should trade long or short. Isn't that interesting? And it's my favorite indicator, and I have a lot, but this is my favorite one. It's called the ATR indicator. It stands for actual true range, and it's a very, very powerful indicator if you know how to use it. So today I'm going to show you two ways to use the actual true range or the active true range indicator. Now, this indicator was introduced to me many, many, many years ago. I would say actually it was introduced to me back in 1996. And when I first saw it, I was thinking to myself, you could just do this yourself. What do you need this for? But it serves a very important purpose, and I'll explain to you why. First, I'm going to show you how to use the ATR indicator to adjust position size, to get equalization of positions. And then the second thing I'm going to do is I'm going to show you how you could use the ATR indicator as a stop loss level to figure out your stop loss levels for whichever asset you trade. Because ATR uses the actual volatility of the asset. And I find that there's no better indicator than the actual asset itself to give us an indication of what the asset will do next. So let me take you through this. I'm going to screen share, and you'll get a really good idea of how I use the ATR indicator. So let's go, and this is bar chart. The ATR indicator is available pretty much on any platform that you could imagine. It's a very old indicator. All it does is this. Let me explain to you how it works. It takes the highest high of the day and the lowest high of the day, lowest low of the day. So in other words, let's say the range of the day is $5. Let's say the stock is moving from $10 to $8, all right? That's a $2 range. And let's say it happens to have a $2 range for 5 days. The ATR averages that. That's all it is. So if it moves from $8 to $10 every day for 5 days, the average will be $2. But usually stocks don't move $2 a day. They move different levels a day. So the ATR can calculate the period for us for whatever number of days without us having to calculate it manually. So let me show you the ATR indicator, and that's this yellow line. I made the chart smaller so you can get a good understanding. So we go to study, we go to ATR, which is right here, average true range. And sometimes it's called actual true range. Sometimes it's called average true range. But that's usually what it is, ATR, average true range. We click on it, and you could set the average days to any period you want. I like to use 10 days. The standard setting that it came with is 14 days. But since we're swing trading and we're looking at stocks and we're looking at shorter time periods, I find the 10-day period best. And as far as smoothing it, I don't smooth it at all. I would leave this completely to 0. I don't want to accentuate the indicator anyway at all. So we just set it to 10 days, smoothing 0, and then add it. And I think it just gave me double the indicator, double the fun. All right, so now we just have the ATR, and all we're doing is this line here tells us what the dollar per day average over the last 10 days is on Microsoft. Now, you're probably thinking to yourself, why is this so important? I'll explain to you why. As a beginner, I'm sure the biggest focus you have right now is which way is the stock going? Is it going up or is it going down? But once you get comfortable with buying and selling and having profitable expectancy, that means profitable expectancy is when over time you have more winners than losers, or your winners are bigger than your losers. So you will find that you're going to start thinking more like an institutional trader. You're going to start matching up your positions. I mean, how often do you just buy one stock and sell one stock and never trade anything else? Usually you compare your trades to other stocks. So what this does is it prevents you or helps you avoid from being lopsided. Let me explain. Let's say I'm looking at Microsoft and I'm looking at AMD, two tech stocks. One stock is a chip stock, the other stock is a software stock. But I'm sure you may want to buy both stocks together because right now, tech stocks are really going wild. Stay-at-home stocks are at a premium right now with COVID-19. So, and again, I'm just using this as an example. So let's say I buy 100 shares of Microsoft stock, all right? Well, the ATR on Microsoft stock is about $5.50. So for every 100 shares that I buy of Microsoft, my account is going to fluctuate on average of about $500 per day, okay? So 100 shares, Microsoft, ATR, average true range, average volatility is about $5.50. So if I add it to my account and I look at a trade tracker, I'll see a fluctuation of $550 on average, 500 bucks. But then let's say I buy 100 shares of AMD. Well, AMD is only giving us an ATR of about 2.45. That's almost half of Microsoft. So if I buy 100 shares of AMD, I'm going to be lopsided. Microsoft is going to be fluctuating $540, and AMD is only going to be fluctuating $2.40. And then let's complicate it even further. Let's add NVIDIA to the mix. NVIDIA is fluctuating 15 bucks almost, right? We don't have to be down to the penny. It's an example I'm trying to explain, the broad picture. So don't look at the little things, look at the overall picture. So one stock is giving us $15 exposure. So if we have 100 shares of this stock, we have exposure of $1,500. The volatility is $1,500 a day. And then we look at AMD, and it's $250 a day. And then we look at Microsoft, it's $500 a day. So you have one stock giving you $500 a day swings, another one $250 swings, another one $1,500 swings. Now, how do you know which stock out of those three is going to make money or lose money? You don't. So you know what a professional trader would do? A professional trader would equalize each one of these to give you equal exposure. Now, you're never going to get equal, cent for cent, but you're going to get it within 5%, 10%. Don't try to be completely equal. This is a guideline. This is not a science, a hard science, okay? And don't try to make it a hard science because you'll drive yourself crazy. You'll be adjusting shares every 5 minutes. So what we want to do is we want to equalize everything to our biggest exposure. Our biggest exposure here, or biggest volatility, is NVIDIA. And let's just say that we want to have no more than $1,500 of exposure, all right, on our account per trade. And we want to give each trade, how about this? We have a small account and we want to give each of our stocks a volatility of $750, all right? Well, as we could see here, NVIDIA has a volatility of about $15. So if we buy 100 shares of NVIDIA, we're going to have an exposure of about $1,450, give or take $1,500. Again, just broad strokes. Don't look at the little pictures. Just say this is 15. So we would buy about 55 shares of NVIDIA, and that would give us $750 exposure. Then, well, you're looking here at AMD, and that's only $250, right? 241, 200. So we would have to buy 300 shares, right? Each 100 shares giving us about $2.50 exposure. We would buy 300 shares. 300 shares of AMD and 50 shares of NVIDIA is giving us roughly the same exposure. Why? Well, NVIDIA is fluctuating at about $15 for every 100 shares, or for every share, and NVIDIA and AMD is fluctuating $2.40. $2.40 versus $15. How do we equalize that to $750? 50 shares of NVIDIA and 300 shares of AMD. 200 shares of AMD would give us $5. Add another $2.50 to that, about $750. 245 times 3, or 300. So now you have 750 shares with NVIDIA, and now you have 750 shares with AMD. Now you have two stocks with totally different volatilities, giving you reasonably even exposure. Let's now bring Microsoft into this. Microsoft is right in between. It's not $250 like AMD, and it's not $15 like or $14.50 like NVIDIA. It's about $5.50. So if we have 100 shares of Microsoft, we would get about $550. So I would say, and I'm eyeballing this. You could mathematically do this. You could do all this with a calculator. But I would say about 150 shares would probably give us about $800. So let's say 125, 130 shares would give us about a $700, $750 exposure. So now you have the same exposure, all three stocks, by using ATR. By knowing what the average volatility over the last 10 days is, you can gauge the exposure and you can equalize it versus shares. So if we bought 100 shares of Microsoft, 100 shares of AMD, and 100 shares of NVIDIA, you would have $550 exposure, $2.50 exposure, $1,500 exposure. Your exposure would be all over the place. Your risk and reward would be all over the place. What if you bought 100 shares of each and AMD was the winner and NVIDIA was the loser? You would have a profit of $250 and a loss of $1,500 or $1,448. You see my point? You would be lopsided. You don't know which of these three stocks is going to be the big winner or loser. So you want to equalize them so you get equal exposure, equal bang for the buck. So what happens when we equalize all of them to about $700, $750? 50 shares of NVIDIA, right? 300 shares, or about 275 shares of AMD, and about 125, 130 shares of Microsoft will give you about $700, $750, all three stocks. And now you could trade all three stocks the same way with the same system and not worry about being lopsided. And now your expectation of profit and loss can be very calculatable. You can calculate. You could foresee what your risk will be, what your exposure will be, because you're pretty much equalizing all three stocks to give you the same or similar bang for the buck. Now, here's the thing. You're never going to be 100% even. You're not going to get always the same exposure, and you don't have to worry about it. If one loss is $380 and another loss is $390 and another loss is $370, it's not a big deal. The key is to make sure all your losers are reasonably same sized and all your winners are reasonably same sized if you're trading the same system on three different assets. Now, if you're trading one asset, it doesn't matter. One asset, one volatility. You could just do 100 shares and not worry about it. But what if you have three stocks? What if you have four stocks? What if you have five stocks? What if you have two stocks? ATR will tell you what the volatility of each stock is so that you can equalize your exposure and get equal bang for the buck with all three stocks. So if I was trading these three stocks and I wanted roughly $700 of exposure, I would trade about 150, about 130 shares of Microsoft, about 285, 300 shares of AMD. And you can always adjust further down the road because volatility is going to change. And that's how hedge fund managers keep themselves busy, by the way. They're always adjusting position size. There's a clerk who's constantly, 8 hours a day, he's just adjusting for volatility to keep exposure on all positions equal to each other. Now, what I'm giving you right now is a very, very big hedge fund experienced lesson. This is what hedge funds do. They're not focused on which way trades are going. They're focused on equalizing exposure, all right? And that's what you're doing. Now, how else can you use the ATR? There's another way. You could use it for stop loss placement. Because this is now telling us what our average volatility is, what I like to do is double it. If the average range is $5, we want to be outside of that range by about $5. So you're using the asset's own volatility to tell us how much or where to put price away. So if we were using ATR to put price stop losses here, this closed at $2 and $206.12. I would double this to about $10. Again, eyeball it, about $10, $11, and subtract that from the closing price. So I would put a stop loss at about the 195 level, right here. And that would keep us away from the noise. And the best way to do it is to subtract that from the low. So if we subtract it from the low, or you could do closing or low. I like to do it from the low, but again, you could play with it. So 200 minus $10, 190. Let's say we're here, 193. Volatility is about the same. It's about $5, 530. Double it, $10. Subtract $10 from the low, and you will have a trailing volatility stop that's dynamic and based on volatility. Same thing with NVIDIA. Volatility is $15. So you want to double that and subtract that from the closing price or the low of the day each day, and that'll give you a trailing price. So for example, let's say this big day right here, the low was 400, okay? Let's just say 400. $30 from 400 is 370. 370 would put us right here. Not bad, right? See, we're putting our stops away from the noise. You double your ATR. You double your 10-day ATR. So to give you a summary, ATR is used to equalize your positions across your account, all right? You need to equalize your positions so you get the same bang for the buck on the way up and on the way down. That way your expectancy of profit can be very easily ascertainable. You also use ATR, or you double your ATR and use it as a stop loss so that you can be away from the volatility or the trading range of the asset, and you're not imposing a stop loss based on some stupid indicator that has no relevancy to the volatility. You're actually using the volatility of the asset itself to dictate how far you should be placing your stop loss away from the asset. And I hope that helps.